Good morning, everyone. Thanks for attending the live cast again on this Tuesday. And I apologize, we were going to have a guest on today, but I forgot that this was a holiday week and a lot of people are on vacation. And she wasn't able to attend. We will have her on next week, and we'll be discussing custodians, people that hold the notes for us. We just get electronic files because we don't want the paper here, and all the services that they provide. And certainly we recommend that you utilize somebody that can hold this paper for you, because it can be unwieldy. In addition to that, it can be very problematic if something were to happen to your notes. So next week we're going to be talking with somebody that can give you some real good and sound advice on keeping your records, and also in doing the recordings for you, in finding lost assignments and so on. So I apologize, but before we get started, again, let me just tell you about the boot camp that we're having, the seminar that we're having in San Francisco on the 17th, 18th, and 19th of July in San Francisco at the Doubletree Hilton. If you are interested, just go to www.notemogul.com. All the particulars are there, and will be 3 days of really intense note education. We won't be selling you anything. We certainly have a guarantee. If you come and by noon on the first day don't think you're getting your value out of this, we will give you a refund on the spot. We'll have our checkbook with us. We don't really anticipate anybody not getting that benefit out of the seminar that'll want to leave. But if you do, we certainly will want to refund your money to you. So it's going to be all education and no selling whatsoever. In addition to that, any monies that you pay to attend, the tuition that you pay to attend can be used as a credit when buying a note from us. So actually the seminar can be free. And then we are going to be in Houston on August 14th through 16th, and in Boston October 2nd through 4th, if those are more suitable to your location. So, all right. So over the weekend and Monday, actually starting last Friday, I had several investors that I talked to, two groups in person came to the office, one on Friday, one on Monday. And because of the foul up on my part of today in getting our guest here, I thought we would go over some math of the note business, because in both instances that we were in the discussions that we had Friday and Monday with some seasoned investors, now not seasoned note investors, but seasoned investors, the calculations on yield and return on investment were what the concern was, and what these two people really wanted to see is how did they compare the different opportunities that are available to them in this note business. And so I'd like to go through that with you today, just to give you some idea of number one, how to price based upon what you're going to make on these notes, or what you project that you're going to make, because a lot of people still are hung up on what did you pay for that note? Did you pay 15 cents on the dollar? Did you pay 20 cents on the dollar? Did you pay 50 cents on the dollar? When really what you should be focusing on is how much am I going to make on that note, not how much does that note cost as far as percentage of the unpaid balance. So I would like to make a couple of assumptions on this, and the first is that we have $107,000 that we want to invest. So we're going to take a look at three different opportunities here. One, we're going to buy a non-performing second. We are going to work out that second, and then we'll keep it for cash flow for as long as we want to keep it, or as long as the borrower has a loan on it before they refi or before they would sell it off, or excuse me, sell the house. The second opportunity is we're going to buy the same quantity of notes again, non-performing seconds, and this time we're going to season that note for a period of time, and then we'll sell it. And the third opportunity is to buy a reperformer, and we're going to have a reperformer priced at a 15% yield to the buyer. So to the yield to the investor that buys the note from you. So we need to use the calculator. And again, we recommend the 10B2 Hewlett Packard. And so let's get started by doing some calculations here. And I need you to get a paper and pencil so that you can write this down as we go. I was going to do a PowerPoint, but there just wasn't time to get that done when I realized that we didn't have a guest, and I wanted to fill it with this opportunity here. So if you would get a piece of paper and you can write this down and all the calculations, and then you can come back to this video and watch it time and time again. Okay, so the first thing that we want to do is we want to determine that we're going to spend $107,000. And let's make a further assumption that we are paying, that we've done our due diligence here, and we are paying 14 cents on the dollar for this. Our due diligence suggested that we would pay 14 cents. So if we divide this number by 0.14, we are going to be buying an unpaid principal balance of $764,285. Now, I'm going to have to admit that some of what I'm doing, I have simplified just for the math today, but we're doing a UPB, total UPB of $764,285, and we're buying, let's assume we're buying 10 notes. All right, so we're buying 10 notes. So if we divide that number by 10, we're buying a note. We're buying 10 notes that each have a $76,428 balance. Now, we know that you're not going to buy a tape, and every note on that 10 tape or in that 10 pool will have a balance of $76,428, but it makes the math simpler here if we just assume that to be the case. So we're going to buy 10 notes. The cost of each of those notes is $76,428.57, and we're paying 14%. So let's take this number times 14%, and that is $10,700. So we're paying $10,700 per note. Everybody follow that? All right, so we're paying $10,700 per note, and the original note that we purchased with the balance is $76,428. That original note was written for $85,000. All right, $85,000. Now, the terms of that original note, $85,000. Let's put $85,000 into the present value. Now, remember, when someone gets a loan, the $85,000 that they receive is positive. So it goes into the present value as positive. Let's further assume that the rate on that note was 7.5%, and that it was a 25-year note for 300 months. So the original payment down, we're going to solve for payment. The original payment, $628.14. All right, now let's make an assumption here. Well, it'd be more than an assumption. Let's go to our amortization table. Everybody remembers how to do amortization. Hit the orange bar and then go up to the right-hand corner where it says amort, and we're going to get that amortization table. Now, we bought a note that had an unpaid principal balance of $76,428. So let's go down the list until we get to that. Okay. Let's use this one right here. 70 months. All right. So when we take a look at this, we know now that the borrower had paid for 70 months and then went delinquent. Let's further assume, so 70 months, if they've paid for 70 months, it means that on a 300-month note, there are 230 months left. Everybody follow that? 230 months left at $628.14 a month to pay that note to zero. Now let's further assume that it's been 36 months since they've made any payments. When we bought the note, they were delinquent for 36 months. So if we take the payment of $628.14 times 36, they have $22,613 in arrears. So there's several things that we could do. We could try to reinstate them for $628.14 a month, and add the arrears to the back of the note. So we add the 22,000 and some to the 76,000 and some, and come up with about a $99,000 balance, and accept $628 a month. But let's assume that when we do our financials, our asset manager determines that there's no way they can pay $628 a month. It looks to her like they can pay somewhere around $400 a month. So the workout specialist asset manager works with the homeowner and says, hey, here's what we can do for you. It looks like you can pay $400 a month comfortably. And if you will pay $4,000 in arrears and pay us $400 a month, we will reduce your interest rate to 3.5%. And if you pay us for 24 months on time every month, we will wipe out the $18,613 additional arrears that you owe us. So the homeowner agrees. Okay, I'll pay you $400 a month at an interest rate of 3.5%. We have to determine now the balance on their note is $76,428. How long will it take them to pay $76,428 if they're paying $400 a month at 3.5%? Well, let's do the calculation. So the interest rate is 3.5, and it's best to always work from right to left, or from left to right when you're doing these, so you don't get mixed up. And the present value is $76,428. The payment is $400. Now remember, the payment is out of pocket, so that is a negative. Switch that to negative. Let's go. We need another zero on there. That goes under payment. It's a fully amortized loan, so there's no future value. And we're going to solve for N. It's going to take them 279 months at 3.5%, $400 a month to pay off this note. So now, what we have is a worked out agreement with the homeowner, with the borrower, to pay us $400 a month for 279 months. All right, everybody follow that? Okay, so let's say that it took us 18 months. Let's say it took us 24 months to get this done. All right, so we have now at the end of 24 months, we are receiving $400 a month times 12 is $4,800 per month. And over the course of the 24 months, let's say we have spent an additional, let's say it's $35 a month. So 35 times 24 is $840 in servicing costs. And let's say there was another $50 in recording costs. We have spent $890 in addition to, the $10,700 that we paid for the note. So we have spent $11,590. That's our out-of-pocket expense to collect after 2 years, $4,800 a month or a year, and for 279 months. Is that a good deal or what? 4,800 divided by 11,000, 4,800. 4,800 divided by $11,590 is 41% annualized. 41% annualized for, let's see, 20 some years. You tell me, is that a decent return on investment if after 2 years you can receive 41% annualized? If you can find that somewhere else, let me know. I'd like to get into that. Let's assume that half of our notes failed. Is 20% annualized for 279 months reasonable? Yeah, it probably is. So this is one opportunity to buy these notes, to keep them for cash flow, and to have a huge return annualized every year for a period of a number of years. All right, so what is option number two? Well, option number two would be to do this very same thing and to sell the note after we seasoned it for, let's say, 6 months. And then we sell it to an investor and we offer the investor, let's say a 15%. Well, let's make it, let's say that we're going to offer that investor a 17% yield. I think that you as an independent investor could find somebody to sell this to at 17%. We can sell it for a lesser yield because we have the infrastructure to handle for the investor, a passive investor, and we would probably try to sell this note at a 15% annualized return to the investor. But let's use 17. So we're going to season this note for 6 months. So we're going to collect 6 months times 400 is $2,400, and we collected $4,000 in arrears. So we have received $6,400, and we are now down, because the loan had paid for 6 months, we are now down to 273 months. 279 minus 6, 273. And we're going to offer the investor 17% yield. So on a 17% yield, we want to find at $400 a month for 273 months, what is the investor willing to pay? Now, in this case, the investor is receiving $400 a month. That is positive. We're collecting $400 a month, and we're going to have to pay out a present value number, and that present value number is $27,628. $27,628. So that's what we're receiving, $27,628 from the investor. And we have already, let's change that to a positive. That's what we're receiving. And we have already received $6,400. We're going to receive $34,028 total for this note over the course of 30 months. 24 to get it seasoned, or 24 to get it working, 6 to get it seasoned. We're going to give 30 months. And we've paid out of pocket expense. If we'll remember, we paid out $11,590. So we have made $22,438.64 profit. So if we divide this by our investment, We've made 194% return in 30 months. If we divide this by 30, we've made, and take that then times 12, we made 77% annualized yield on that investment. Again, if half of our notes fail, our investment's down into the 35, our returns down into the 35% range. And that's still not too bad. Now, now we've done something where we bought non-performing notes. Let's say that we're a passive investor and we don't want the risk involved in this non-performing note business. And this is kind of the discussion that we got in this weekend with, or this past Friday and Monday with two different investors. It was kind of comparing these opportunities and what do you want? What kind of risk are you able to tolerate? And what kind of return are you looking for? Because the more risk, of course, the greater the return. But the investor that just bought this note is getting a 17% annualized yield on a $27,628 investment. They're going to be making $400 a month for 273 months. Now, what I'd like to do real quick is to take this and make it more in line with what our price would be to sell this. And we would say we're going to offer this to the investor at a 15% yield. So they're going to have to pay just shy of $31,000 for this note to get a 15% yield. Now, a lot of people would be very happy to receive a 15% yield every year for 273 months is, let's see, that's a 200 or 20 years approximately. So, so you're going to get a 17% yield. Now, everybody realizes, most of the people that are on these, that are getting involved in delinquent notes, are real estate investors or have done some real estate investing, and they realize that there really isn't many. There aren't many mortgages that last for more than 7 to 10 years. So if this mortgage pays off in the 7 to 10 years that are average, and this one's already been going for, we said, 70 months. So it's already been going for 6 years. If this paid off, keep in mind, you're going to get paid off at the $76,590 number, not what you paid. You're going to get paid off on the full balance of the note. So if the homeowner sells the house, or if they refinance, you're going to get the full balance of the note. Or if there isn't enough equity, you're going to get, which is a point, you're going to get what equity you can agree to out of that, but you're going to do far better than getting a 15% yield. But that's only one way that you can make money on this deal. The second way is that you can season it further and then sell it for a better rate. So let's just make an assumption here. Let's say that you, the investor, and this had been seasoned already for 6 months, that you season it for another 6 months. You collect payments for another 6 months. So you're collecting $2,400. If you collect it for 6 months, then the end number, the number of months here, is going to change. It's going to change for 6 months left. That's 267 months. Whoops, sorry, 2, 6, 7. Payment's still $400 a month, but you, let's say, are going to, because now this is seasoned for a whole year. In addition to that, it's now been paid for 82 months. The likelihood of it going another 24, 36 is somewhat, the likelihood is reduced, because it, at some point, if it meets the averages, it's going to either be refied or sold. So let's say that now you can sell that for a 13.5% interest rate. What would you be selling it for? $400 a month for 267 months, 13.5% interest to the investor. That investor is going to pay $33,762. Remember, you paid $30,839. So if you pay $30,839 and you sell it for $33,762, you made $2,922.58. Plus you collected $2,400. So we got plus 2,400. You made $5,322 on $30,839. $38.39. 17% in 6 months. Remember that you kept it for 6 months and sold it, times 6. Oh, excuse me. I'm sorry. I did that. That's crazy. I had 6 in my mind. You had 17%. 6 months is a half a year. So you would double that for an annualized return of 35%. Now, if you are the investor, those are the kinds of decisions that you have to make, and you make them based upon what you're going to make and what you want to do and your risk tolerance. So it seems like every time we do a seminar, the math is what people really, really want to see, because they want to be able to weigh their alternatives. So in this case, we've done a non-performing note that returned to you, the investor, 77%. We've done a performing note that returned 15% if you keep it, 35% if you season it and sell it. And these are just all great alternatives depending upon how you want to participate in the business. So we'll cover almost a whole day of this math and how you can actually enhance the value of the notes that you buy, simply by being able to use a calculator and determining these yields. And that's the whole secret to the business. A lot of people, by the way, they once they have a note paying, they quit. I mean, they just say, wow, I'm returning a good amount on that. My yield is great. I've got a good annualized return on investment. I'm very happy with it, and that's fine. However, there's a lot of other ways that you can make money with these notes if you really pay attention and you pay attention to the math. So again, thank you for attending. Sorry about our guest not being here today, but she will be here next week. We'll have a real good discussion with her on some value that she can bring to your guys' note investing. And please don't forget about our boot camps. San Francisco on the 17th through the 19th of July at the Doubletree Hilton by the airport there. Lunch will be included every day, so it'll be a real chance to network with other note investors. And with all of us, our whole team will be there, including me, Chrissy, Tyler, Sabrina, Ingrid, and Larry Canfield, our pricing desk manager, will also be there for the 3 days. That if you have questions on how he puts together a bid on a tape, he'll be happy to give you all the information that he can. We'll be mingling. We'll be having lunch with you every day. It's going to be not only a very intense educational experience for you, but it's also going to be a lot of fun, and we hope to see you there. So again, see you next week. Thank you very much for coming today, and please take a look at the boot camps or the seminars just to see if it's something that you think you could benefit from. It can be free. Thanks.